Hi, it's Ben Murnane here with Live and Invest Overseas, and I'm here with Leif Simon, our diversification expert and editor of the Simon Letter, and our investment director. Many hats, Leif. I think you might need them all for what we're going to talk about today.
Yeah, it's hard to keep up with what's going on today, but yeah, we're going to try and talk through it.
Right. I mean, it's just been a crazy week in the US banking sector. Really kicked off with the collapse, I guess, of Silicon Valley Bank and the FDIC stepping in. And then the Biden administration guaranteeing all depositors, not just the 250,000
Right.
guaranteed by the FDIC. That was followed by the collapse of two more banks, two more cases where the FDIC stepped in. And now we're just seeing huge knock on effects in the whole banking sector, and not just in the US, but actually, Credit Suisse in Europe, stock down 30%, a record low. We're really seeing huge knocks in confidence in the whole sector, and it really seems to be spreading beyond US shores far and wide. As I say, it's hitting here in Europe, and I'm sure it's going to hit elsewhere. So, Leif, what do you do in a situation like this? I think the value of speaking to you is you've been through experiences like this. You've actually had bank accounts close on you in different places
Right.
around the world.
Well, I guess my first reaction to SVB on Friday was that's what happens because it's happened to me where banks have closed, not because of financial issues, but because of regulatory issues. And I'll talk about that in a minute. But what was going on with SVB, and my first thought was, well, the issue there seemed to be the bank itself wasn't diversified. Its clients were mostly Silicon Valley startups. So, those startups have lots of money flowing in at various times, but if that stops and the bank then doesn't have new money coming in to pay out whoever's paying bills or whatever, they have to start selling some of those bond assets, which were less valuable because of interest rates going up. So you could kind of blame the whole SVB thing on the Fed for raising interest rates that made the bank's assets worth less. But yeah, there's too many factors going on there. The FDIC, right? It's $250,000 insured per client, per account holder, not per account.
Right.
And for individuals, that's usually enough. For the businesses that were banking with SVB, the Ruco, I think it was, had 500 million of their cash sitting there. It was 25% of their cash. So at least they were diversified, which is what we're going to talk about. So it wasn't all of their cash. They have 2 billion in cash. It's a problem to have, right? As a friend of mine says, more money, more problems. But they were at least diversified. And then listening to Kevin O'Leary on the news as well, talking about just you as the client need to be diversified. None of his businesses, he's from Shark Tank, for those of you who don't know. And so he's on the news more and more, touting his business knowledge. But none of his businesses are allowed to have more than 20% of the liquid assets in any one bank. Now, having 5 bank accounts for many people, it might be too much administration, but that's what you really need to do to protect yourself, even in the U.S. as it's showing that the last banking issue was in 2008. And there was concern about contagion there going on in the industry. There's concern now about contagion going on in the industry. And there's, 3 banks in the U.S. have been effectively taken over by the FDIC. One bank having issues now in Europe. What's the next bank that's going to have a problem? Impossible to say. But when banks close, as long as there's a reason for them to reopen, they typically reopen. And I've lived through this 3 times overseas, twice in Panama and once in Andorra. And the reason for the banks there getting shut down were regulatory issues. The first one in Panama was the bank owner had the main bank was in Antigua, Barbuda, or was it Aruba, one of the A islands, and he had issues with the SEC or some other federal. It was American federal agency in the U.S. and that didn't affect what was going on with the Panama Bank, but the Panama banking superintendent, took over the bank to keep the U.S. from trying to take the assets. And so, in fact, the Panama banking superintendent was protecting the account holders in Panama from the U.S. government. And that worked out, except it took about a year for us to have access to our money again. And the other two times that this happened were money laundering claims by the U.S. against the bank. And again, in both of those cases, it took about a year, 2 years and a half, and we had access to our money again. Now, most people can't wait around for their money for a year and a half, which again is a reason to be diversified. So the danger of a whole bank closing is relatively small. So this is a reasonable sized bank, the SVB, 200 billion in assets, ranks it in the top 40 or so banks in the US. But what I've found more probable over the last 15, 20 years is that the bank is going to not close entirely, but it's going to close your account for various reasons, for banking regulations, for concerns over risk. And we've had a business account closed by Bank of America during the FATCA and risk, I forget the term now, the de-risking process that happened after FATCA, and in the process of the U.S. being more concerned about money laundering than the FATCA reporting that was created. And they closed our bank account because we were with a non-U.S. company, and even though we had U.S. reporting and U.S. federal ID number, because Bank of America was de-risking and changing their portfolio. And we've had that ourselves personally with banks offshore. We've known hundreds of people who've had their accounts closed both in the U.S. and offshore for various reasons. So you're more likely to have your personal account closed, which means you should have another account to be able to move that money to. It's called the 30-day letter in the industry. You get a notice from your bank saying you have 30 days to move your money out because they're closing your account. And if you've got a company account and you've only got one, setting up a company account is much harder in 30 days. It's going to be difficult. So one recommendation we always make is have at least 2 bank accounts offshore so that you have someplace to move your money to in case one bank decides to close your account. But of course, the other reason is what we're talking about today, not having all of your money in one bank to help protect yourself.
Right. And I suppose people will associate maybe going offshore or having multiple bank accounts with either the ultra rich or people who are trying to maybe scam the IRS or something like that. But I think your message has always been everyone can do this. And not only that, everyone should be doing this precisely for moments like right now.
Right. And for some people, it'll be hard to maintain balances that make sense in 2 or more offshore accounts, or even 2 accounts in the US in some cases. That $250,000 threshold for FDIC is the FDIC's number. People ask all the time, is there similar insurance to FDIC in this country or that country? Most countries don't have that backstop. Some do, and where they do, like in Europe, in places, it's a much lower amount. So you need to understand the rules of the banking system that you're putting your money into, and opening up 2 offshore accounts to have $5,000 each in them is a lot of administration and expense. So for you got to grow into this. Is really what it boils down to. And for someone who's just getting started or doesn't have a lot of cash, liquid cash that they need to place, maybe you only do have the one account, but keeping in mind that you need to continue to look at diversifying as your portfolios grow.
Right. And I think the thing about being diversified is then you really can ride out moments like this with a certain amount of security, because you know that your bets are hedged to a certain extent. I mean, a couple of banks collapsing, one of your banks closing, you still have your other accounts there. Like even for moments like right now, which feel very scary, I think, to a lot of people, if your money is spread out in different places, the world is always going to need a banking sector, right? Banks are going to come back just like what happened after 2008. So you really can give yourself a lot of security if your risk is spread out.
Yeah, absolutely. And I feel bad for the businesses that are banking with the Silicon Valley Bank. where all their money or a big chunk of their money was there, and they've got to make payroll. So I think that was the biggest concern that the Fed and the FDIC and the White House and whatever were talking about over the weekend was whatever about the bank, but you need people to stay employed and business to stay in business. And I think that's probably why they decided to fully backstop accounts above 250,000. Now somebody's going to pay for that, and it's going to be the banking system itself. So the insurance premiums on deposits are going to have to go up. The FDIC wasn't hugely overly funded to begin with. Like, their cash on hand wasn't huge last time I checked. So if multiple banks have problems, then the FDIC doesn't have enough cash on hand themselves, which is why I think the Fed is in the conversation, and again, the White House. So somebody has to pay for this. Biden has said the taxpayers aren't going to pay for this, but they are, because taxpayers are consumers. So again, it's going to be paid for somehow, maybe not through taxes, but through higher banking fees or lower interest rates or something. As a lot of people are moving to the big five banks, who are considered too big to fail, but they're the ones that are going to be charging the fees to cover all these potential losses.
Right. There are other knock-on effects that you maybe don't see. And even, if we end up with fewer banks, certainly this is something we've seen, say, here in Ireland, where I am right now, when after 2008, the banking sector became much more limited, and, the state basically controlled the two major banks, and a number of other banks left. I mean, the economy then is affected in a big way because the services that are available are constrained. So I think that's something people need to be aware of if we move to a situation where there are fewer banks.
Right. Yeah, absolutely. But again, the first thing is, if you've got all of your money in one bank in the US, go open a second account today. Don't move all your money from one bank to another bank. That doesn't create diversification, just shifts the risk. And if you've got all of your money in the US, even in multiple accounts, look to be moving some of it into an offshore situation, whether you're holding that in dollars still, or deciding to hold some other currency, euros, Swiss francs, pounds, etc.
And would you recommend that, Leif? Would you say you shouldn't have all your eggs in one basket in terms of a US dollar, all your eggs in the US dollar and US dollar investments?
I mean, generally speaking, yes. It depends on your personal situation. For my situation, my operating currencies are mostly US dollar and euro. So Kathleen and I split our time between Panama and France for the most part. And so I have euro assets and euro bank accounts, euro cash, and I have US assets. Panama uses the dollar, so US dollar accounts and US dollar assets. And that's all I really need to be diversified for how and where I spend my time. But you may want to go beyond that personally, and really, if you're going to be spending time in countries with other currencies, say Colombia, for example, which is another place we have an apartment to spend time. I have, of course, the asset there, and I have a bank account there with a small amount of cash. But in the case of the Colombian peso, it's gotten weaker it continues to get weaker against the US dollar and the euro. So I don't keep that much cash directly in pesos.
Right. Yeah, you really got to look at the fundamentals of the particular currency, the particular investment as well. And just to say, we're not giving financial advice. Leif is not giving financial advice or investment advice. This is merely Leif speaking about his personal situation, and we're offering.
It's more lifestyle advice than anything else, so that you can protect yourself and have and be able to pay the bills wherever you are in the world.
That's for sure. Yeah, absolutely. And I think that's something that really will kind of hit home with people in a moment like this. People will wonder, well, what is reliable? What is safe? We used to have, I think, a saying here in this part of the world, in Britain and Ireland, safe as houses, when something was absolutely 100% secure, right? And then I think, 2008 shook a lot of confidence in terms of that. You didn't hear that phrase so much anymore. Maybe the banking sector, people used to think you put your money in the bank and it's always safe, right? But you reach a moment like this and people wonder.
Right. the one thing that creates risk anywhere is leverage. And so again, with the SVB investing in bonds, those bonds were fine. Nothing wrong with underlying bonds. It's that they had to sell them at a loss to cover the withdrawals. So they didn't, and it sounds like they had a very strong liquidity ratio, which is a term used in banking, that they were able to pay out 22% of their deposits on that last Thursday or whatever it was, but it was that 23% that put them, pushed them over the edge. And so that's one thing to look at when you're looking at banks, especially overseas, is what is their average liquidity ratio. And in Panama, at one point, after the pandemic, I looked at several banks' liquidity ratios, and it was like 48%, which means they're holding in cash $48 for every $100 on deposit. That's a huge liquidity ratio. During the 2008 crisis, some of the U.S. banks' liquidity ratios were in the low single digits. So if I remember correctly, like 2% or something. And so that was a very precarious place to be. And fortunately, nothing too tragic happened at that point. But one incident, as a banking friend of mine would say at that time, could have collapsed the entire system. So liquidity ratio is important when you're looking at banks, especially overseas, to see how they manage their cash and see what kind of investment risks that they take. In the case of the safest homes, the Irish saying that you just mentioned, right? Real estate is solid, and you can hold on to it until you need to sell it, unless it's leveraged. If you've got a mortgage and you're making monthly payments, and all of a sudden the value goes down, and now what you owe is more than what you can get out of the house. Obviously that's an investment problem. But if you just own the house outright, you can use it, rent it, do whatever you want to with it, and wait for prices to go back up. And that was the issue with the SVB and their bonds, was they had to liquidate them to cover the cash, and that meant they took big losses on those investments.
Right. And I think you made a key point, which is applicable to now for sure. But certainly in the case of 2008, I mean, in many ways, it wasn't a real estate crisis. It was a mortgage crisis, as you point out. But to that sort of question of what can you rely on, I really think you have the key message that people need to take home, which is that you can rely on yourself to make the right decisions about your own investment situation, if you are informed, if you are able to diversify, if you take the steps that you need to take.
Right. And that's a big, a big question mark out there. Always people want to have freedom, but with freedom comes responsibility. So you need to be responsible for yourself, and you need to manage for yourself, and not expect the banks, the bankers, the government, or whoever to be looking out for yourself. You've got to look out for yourself.
100%. I think that's a good message to end on, Leif. Thank you so much for taking your time today. We'll be talking to you again soon, I'm sure.
All right, great. Thanks, Ben.